Let's do it, folks. Good morning, one, and good morning, all, really. Welcome to The Street today here from Post 35 on the floor of the New York Stock Exchange. Today is Tuesday, the 7th of March. I'm your host, JD Durkin. We're about an hour or so into trading. We've got a lot of red on the big board. Let's do a real-time market check here. The S&P is down 0.7. Tech-heavy NASDAQ down 0.7. The Dow Jones is down about 0.4 or so. Yesterday, the big story helping drive up the Dow was a bit of an anomaly versus the rest of the index. The big story yesterday was Apple. That stock is trading down fractionally as we speak. Only four components of the Dow 30 right now in positive territory. The rest are in the red. The biggest laggards in the Dow currently are 3M, Home Depot, and Walgreens. All 11 sectors in the S&P 500 down in the red as well. This says all investors are eagerly awaiting more comments from Jay Powell. He is currently testifying to the Senate Banking Committee in Washington on the state of the economy and, of course, the future of interest rate hikes. Spoiler alert, more hikes are coming. That's what he'll continue to say. On the show this morning, we will talk Fed as we listen closely to what Mr. Powell has to say. We'll also preview the latest jobs report that is set to be released on Friday morning. That's right, folks. Get your bagels and coffee ready. 8:30 a.m. Friday morning. I'm far too excited. Plus, we'll tell you what's going on with Tesla as the automaker slashes the prices of two of its most popular vehicles. And finally, that's already a jam-packed show, but we've even got more. We'll bring in the details on Meta as the social media giant reportedly plans even more job cuts. You're saying more job cuts? Didn't they already? Yes, they did. There are plans for more. For more on those stories and so much more, let's bring in our special guest for the morning. Loreen Gilbert is Chief Executive Officer and founder of WealthWise Financial Services. Loreen, good morning.
Good morning. Thanks for having me.
Of course, it's great to have you. Of course, all eyes on the central bank this morning because today ends in Y. So in this current economic environment, we always watch the Fed very closely. As interest rates are expected to move higher than expected. Yeah, let's start with the Powell testimony. Obviously, it's going on as you and I are talking right now, and I'm watching it here to the side of the screen. Democrats, Republicans, we call the Senate the cooling saucer where cooling heads prevail. But I wonder what you expect either Powell to say or lawmakers to question Mr. Powell about today.
Well, his notes beforehand were very hawkish, and what we've heard so far this morning is a hawkish tone. He's indicated that they may have to accelerate the rate hikes, and he's also indicated that they're going to take it meeting by meeting and make a decision each time based on the data that they're seeing. And what they've seen most recently is a tick up in inflation, and that is concerning. So with that, we can expect more rate hikes.
Is there this, you have a sense here that Powell, I'm really interested in this debate about whether or not Powell pays attention to the stock market. What would be your answer to that question? And especially on a day like today, do you view the man as being careful not to give the doves anything to trade on? Because the Fed officials have been pretty consistent with what they say, which is, as we know, Loreen, we're not always on the same page, investors and the Fed.
Well, exactly. And that is the fine line that Powell has today before the Senate committee. And just they don't want to see the economy collapsing. And yet Powell needs to be strong to bring inflation down. And that is the difficult measure. And the reality is he has told us that it's going to be painful. And frankly, we really haven't felt that much pain in the economy yet. We haven't seen unemployment numbers come up. And our expectation, even this week, is for those numbers to be incredibly low still at 3.4%. So with that, that says that the Fed still has more work to do.
I wonder what you'd be looking for in terms of the senators and their questions today. We'll hear from a notable number of senators. That includes Senators Warren and Warner, Democrats in the majority. New Senator J.D. Vance makes a lot of headlines. He's in the minority. He's on Senate Banking Committee. I'm sure we can expect a fair bit of political theater because it's, Capitol Hill. But when Powell testifies, what sorts of questions does he often get? Or what would you ask him if you were a senator in the room, I wonder?
Right. Well, I mean, if you take it from the senators' viewpoint, they're concerned about their constituents. They want to know that the communities that they report back to are going to be okay. And so their concern has to do with their voters, with consumers. And the reality is consumers have still been incredibly strong. But if we look behind the veil, if we look at consumer debt and consumer revolving debt, those numbers have increased by almost 20% year over year. That is a huge increase in consumer debt. So where the consumer has been incredibly strong and robust, We don't think that the consumer can continue to be as strong as the consumer has been.
Time now for the daily obligatory soft landing question. Where do you think we are, Loreen, in terms of a potential soft landing, or are you in the no landing zone, or is it option C, none of the above?
Well, I think the bottom line is I think it's going to be hard to avoid a recession. And whatever that looks like, we don't think it's not going to be an '08 situation. We don't think that. But I do think we're going into recession. And what does that mean? That means unemployment numbers are going to increase substantially from where they are today. And by the way, the average unemployment number since 1948 to the present was 5.73%. We are a long ways away from that at 3.4%. So as companies see earnings decline, as companies see profit margins compress, that's going to mean that they need to lay off people. And what we've seen so far has been very contained in the technology space. It has not been widespread. And even if you look at just technology, it's not, those layoffs are not that significant simply because they hired so many people during the pandemic. So we're just getting back to kind of pre-pandemic levels. So with that, that all tells us as rates increase, as profit margins decrease, as earnings are negative, then we're going to see more layoffs. And that will start the impact of consumers being impacted and consumers slowing their spending.
I can't help but ask if you have a base case on a timeline. We are, of course, just a few days away from the next jobs report, but to the point of unemployment, the last jobs report, no one saw it go down to 3.4%. Everyone expected it to go maybe slightly higher, 3.6, maybe even 3.7. It's trending the right way in a normal economy, and any White House would celebrate this, but we know seeing unemployment come down runs counterintuitive to the Fed's goals. So talk to me about when you would hope to see some alleviation within the system, because it's pretty stubborn right now.
It's very stubborn, absolutely. And so I think we're looking at mid-year. Mid-year is when I think all things kind of come together, where we realize, okay, we're finally in a recession at that point, and those, the slow growth continues, and then you see unemployment numbers starting to tick up more. But it may take a while, just as we know that those rate increases have a significant lag effect into the economy and can take a full year to go into effect. So as we see, though, especially if we start seeing, instead of 25 basis point increases, if we see 50 or even 75, that will have a major impact. That will end up speeding us up into that recession.
Yeah, and I wonder if 50 basis points is now potentially back on the table. I'm taking a look here at the FOMC calendar. So obviously we have a meeting and a decision coming up here in March. Then we've got one in May and June. You say middle of the year, Loreen. Is it your expectation we might have 3 rate hikes of 25? Might, given what even Mr. Powell is saying today in the Senate, kind of jostle that back higher? He's not taking it off the table. He's not explicitly saying 50. I'm not listening to his answers right now, but at least in his prepared statement, he kind of hinted that maybe the pace needs to be reconsidered as well, even though we've been in this period of kind of sustained 25 bips for a few meetings.
Exactly. So our base case has been 25 basis points for this next meeting. But given the statements that are being made today, it very well may be 50 basis points. So I would say it's either 25 or 50. I don't think we're going to 75 at the next rate hike.
Talk to me about the inflation. We just heard Mr. Powell just moments ago once again say, obviously, the goal is to get back down to a 2% target. We've heard from some Fed officials who have said we're not getting there in 2023, may not even get there till closer to 2025. And other voices who argue the Fed should raise its inflation target altogether. Let's set it for a standard a bit higher than 2%, given how stubbornly entrenched inflation proves to be, at least in services, at least in some of the lagging indicators. Where do you stand on that? Should the Fed still be shooting for 2?
I think they need that messaging. Absolutely. They need the message of 2. Whether they actually do that or not, that's going to be the message. If you read the statement ahead of time, the monetary policy statement, that 2% number was reiterated over and over and over again. Even this morning, we keep hearing 2%. So they're not going to let go of the 2%. But like you said, that's not going to happen until more like 2025. So it's going to come down slowly, but it will be a slow impact. It will take time.
And I'll quickly just finish off this section with just two sentences from Mr. Powell's prepared remarks before we move on to something else. Powell telling senators moments ago the latest economic data has come in stronger than expected. It suggests that the ultimate level of interest rates is likely to be higher than previously anticipated. If the totality, says Powell, of the data were to indicate that faster tightening is warranted, we would be prepared to increase the pace of rate hikes. That goes back to our point about the potential for 50 basis points. CME Group, the Fed Watch, puts that now as high as nearly 30%. Loreen, this was unthinkable back in January, right? When the bet was, oh, we're heading into a recessionary environment. Oh, the Fed will be cutting rates in 2023. I mean, what do you say to someone looking at the outside saying we had this conversation a few weeks ago and it looked entirely different?
Remember January of 2022, when we were told there were going to be 3 rate hikes. We thought there would be 3 to 4 rate hikes, and maybe 25 basis points. We ended up with 7 rate hikes, and a huge increase in that Fed funds rate. So what we're seeing now is a similar story. We could end up in 2023 with many more rate hikes than we anticipated. And therefore, when we transition that into what does that look like for investors, investors need to consider that, one, we're going to recession most likely, and most people know that. It's the most anticipated recession we've ever had. So most people know that. But what we're not seeing is any change in behavior by consumers, even though we know we're heading towards a more difficult economic environment.
Yeah, we absolutely do. And so thank you for all that, and thank you for the context, and thank you to our viewers at home who have been following along as we've been trying to give you our updates to Mr. Powell's testimony. On broader economic data, if I can, on jobs numbers, we're tracking, of course, with regards to Friday's numbers, that is, we got the top line print, we got unemployment, you and I discussed a moment ago. But perhaps the most important to some observers would be average hourly earnings. Speak to us about what we want to see, or what do you want to see out of those numbers, and what else we might be able to learn come Friday morning from the Bureau of Labor Statistics. We do love Jobs Fridays. It's a fun day.
Yeah. Well, from a market perspective, we want to see that wage inflation is not out of control, that we have, in a sense, a leveling off. Because as wages go up and hourly wages continue to go up, then we have more pressures on companies. Once again, that's where the profit margins are going to be compressed more, and therefore then ultimately, as earnings are going down, then there are more layoffs. So it's kind of counterintuitive, because from individuals, they want to see hourly wages continuing to go up. And if you really look at the numbers, they haven't kept up with the overall inflation numbers. So if you're an hourly worker, you're wanting to see those numbers go up. But if you're looking at markets and the economy and what's going to happen, we need to see a kind of a leveling off as far as wage growth is concerned.
Yeah, absolutely. I don't want to jump sections here because I get in trouble when I do that, but just a quick update with regards to how things are trading. We are seeing the 2-year start to move up quite a bit here. Since Powell started talking, we started the day, it was a bit closer to 4.8 and change, is now 4.9. We're seeing some movement on the 10-year as well, so we'll continue to follow that. But back here to the jobs numbers, if we see another red hot report like we saw in January, I think that might impact the Fed's next move. And I also wonder, if you're Mr. Powell, do you wish you had that jobs data first before you had to go to your semi-annual obligation of talking to lawmakers?
Well, we had that huge jump in January that was unexpected, and I don't believe we're going to see the same kind of number for February as we did in January. And so, but it could still be incredibly strong. And so, of course, those numbers are going to impact the way that the Fed looks at raising rates. And what they want to see is that those numbers come down.
Absolutely. Okay, so thank you for doing a bit of a preview there for Friday, because it's one of, if not the most important data point we get in the next few days. With regards to general morning market, stocks looking to extend here a bit of a winning streak. You see it says momentum continuing as March gets underway. How are you approaching this market day by day, knowing that we're only ever one data point away from a pretty big swing one way or the other?
Yeah, when we look at the, hold on just a moment, something just went off. Okay, so what were you, can you please repeat the question?
Oh yeah, just talk to me about your day-to-day approach in the markets. I mean, we're in this environment where we wake up any day, any given piece of data we get at 8:30, at 10 o'clock, at 2 o'clock in the afternoon can have this pretty notable swing one way or the other. How do you approach a day session when you
Yes.
have no sense on what investors are going to latch onto?
Yeah, I think that when the way that we view portfolios is looking at where are we in the economy, where are we in the markets, what do we see for this year overall? And overall, we think it's going to be more of a value market than a growth market. Still keeping growth positions, that's important because, of course, we started the year off very strong in growth and huge rebound. So, of course, we want to have some those growth positions. And we've seen a rebound in small and mid caps. So that's been encouraging. But if we look at the backdrop of where we are in a slowing economy and investors wanting to be a little bit more conservative as they're concerned about what's happening in the economy, then we look to large cap value, which is a great place to be at one of the least impacted areas when we go into a recession. So overweighting that kind of large cap value dividend paying stock area. And then for liquid assets, looking at municipal bonds, looking at bonds altogether. When we look at how much inflows have been into cash over the last week, it's substantial. So what we're seeing is investors are very nervous and they're putting a lot of money in cash. And of course, you can look at those, short-term rates and they look very appealing. But another thing to look at is if you're investing in municipal bonds, you're getting the tax-free income, and make sure you look at the tax equivalent yield because that tax equivalent yield may be much higher than what you're getting with what seems like a high number on those short-term rates.
It sounds to me as if you would consider yourself a fan of fixed income, at least for the short term. Is that a fair read? You like
Very
some of
much so.
these shorter term notes given the movement? Yeah.
And then, but also going out a little bit longer in duration than the benchmark, you know, making sure that you have some shorter term assets, but also as we look at eventually the Fed coming to their terminal rate, which we know we're closer to the terminal rate than farther away from it, then starting to go out a little bit longer in duration.
Yeah, it's incredible. We closely follow, as I'm sure you do too, the spread on the 2 and 10-year yield right now, and we're looking at a spread of minus 0.91. This is the steepest that we've seen going back quite a while. We're talking many years since we've had that spread. And as Mr. Powell speaks, we do have, again, that 2 years moving up, that 10 years moving down, kind of further exacerbating that spread a bit. I do want to ask you about earnings while I have you, because earnings season is mostly behind us. We're still getting some late trickling names here. The percentage of companies beating earnings remains at about 69% or so, below the 10-year average of closer to 73%. Talk to me, Loreen, some of your biggest takeaways from Q4 earnings season as a whole, now that we've got at least most of it and certainly the big names behind us.
Yeah, it was pretty much an earnings season that we expected. And when we look as well as the guidance that companies are giving, there's still a lot of negative guidance. And so we do believe we're in an earnings recession. We've seen 1 quarter of negative earnings. We think next quarter is also going to be a negative earnings season as well. So just like I was saying earlier, with those profit margins that are compressing and those earnings that are negative. So this is definitely a stock pickers market. It's not a broad-based index market. Security selection is ultimately going to be key in 2023. So that's what we're looking at, is security selection, really looking at individual companies and where can we add some alpha into the portfolios by choosing those individual names.
And I guess that's your challenge, right? Is trying to find those individual names best to position yourselves for. I wonder if you're in the camp of a potential profit or earnings recession. We're hearing a lot more about that if we start to have consecutive quarters here, and a lot of these companies are kind of trending the other direction. Where do you fall on that question that has suddenly come to the front for many
Yeah,
people here on the street?
we definitely think that we're in an earnings recession. So we've already had the 1 quarter of negative earnings, and we think that's going to be another quarter of negative earnings. So yes, I think that we're there, which then leads us into more of a broad-based economic recession for our country.
All right, appreciate the context on that. Finally, a few more generalized questions here. People that are, maybe they've been in the market for a while, maybe they're entering the market and they're saying, uh-oh, what does my timing look like here? People want to know where the good buying opportunities are. We always say buy the dip. The challenge, of course, being we don't necessarily know where the dip is. Do you view right now as an overall pretty good buying opportunity? And what stands out to you if that doesn't apply necessarily to all sectors?
Yeah, I think that investors need discipline, and it's the hardest thing to do. Nobody wants to be disciplined when they see a year like last year, or even the volatility that we're telling people we expect choppy markets over the next 3 months as the Federal Reserve continues to raise rates. So nobody enjoys that. It's hard to put your hard-earned money into markets when it's volatile. And yet, for the long haul, that's absolutely the best strategy. Once again, being key with where are you putting those dollars, adding in more value. We also like international quite a bit because when we look at the dollar that has been incredibly strong, it will be rolling over as we get to that terminal rate. And other countries still have a lot more to do with raising rates, and we're closer to the end of raising rates, then the dollar will start to weaken. And with that, that's going to help your international names. So most people are underinvested internationally and really looking at developed markets for international investing and some emerging markets for international investing makes sense in a portfolio. The other thing I would say is looking specifically at some sectors like industrials, healthcare. Those are two areas, and then financials is a third that we really like in this market.
As a wealth manager, what are some of your tried and true investing tips?
Yeah, I think for investors, that idea of dollar cost averaging is key, making sure that you're continually and consistently putting money into the markets makes sense. The other thing is finding a risk tolerance that you can stick with over the long haul. What happens to investors is they want to be aggressive when the markets are going up, and they want to be incredibly conservative when the markets are going down. And if you have a whipsaw in your asset allocation, you can hurt your long-term returns. So instead of that approach, honing in on what are you going to be comfortable with, whether the markets are going up or the markets are going down, as far as your allocation between equities and fixed income. And the other investing tip I would give is make sure you have a healthy amount of alternative investments in your portfolio. And alternatives can be different things, but it can be everything from adding in commodity exposure. We consider that an alternative, and we have commodity exposure in our portfolios. Looking at different areas like long short, market neutral, merger arbitrage, all the different types of investments that can, in a sense, hedge you in a volatile market environment like we're experiencing today. And we keep a healthy amount of alternatives in our portfolios.
All right, and finally, what are some of the most attractive sectors on Wall Street right now, you think?
Yeah. So like I was saying, industrials, healthcare, financials, we like that. We like those areas of the market, financials, because, as interest rates continue to go up, that tends to be healthy for your financial based companies. And we've seen even companies like Visa say, they've seen the consumer be incredibly strong. So companies that we see that are focused on financial services tend to be a good investment we like right now, as well as industrial companies with all the money that's being spent in infrastructure, then that is a good play for industrials. And then healthcare as a defensive play is something to consider. As we know, going towards a recession, healthcare, people still have to spend money on healthcare. It's almost 20% of our GDP, and it's a good area to consider as a defensive play.
That's a great conversation. Thanks for all making us smarter together. Loreen Gilbert is Chief Executive Officer and founder at WealthWise Financial Services. Loreen, thanks for the time. A great conversation. Nice to have you.
Thank you so much.
You got it. We'll do it again soon. All right, folks, coming up on the show, we will be bringing you, there we go, the latest headlines on reported Meta layoffs and Tesla price cuts. But first, tech analyst Dan Ives spoke with my colleague and good friend Catherine Ross about his outlook for the tech sector in 2023. Take a look.
Dan, fourth quarter tech earnings were lackluster to say the least, but tech stocks are up big. What's your forward-looking outlook on the tech sector?
Look, I think a lot of bad news is baked in. And I think what you're seeing are some stabilization on enterprise and consumer trends. That's really been the big trend in tech earnings. Look, we believe, going into this year, tech stocks are going to be up 20%. Clearly, we've seen huge move coming out of the gate. I think it's just starting. I think there's a risk on. We'll clearly see some choppiness, but we're bullish on tech going into this year despite the dark storm clouds.
Well, do you think that this makes it a buying opportunity then?
Look, I think it's high quality tech you really need to look at. Names like Apple, Microsoft, Salesforce, cybersecurity names like Powell. Though I think profitless tech will continue to sort of sell off. But I think that's really what I view as differentiating in this market, the types of tech names you want to own, because it's clearly going to be, I view as a fork in the road across the sector.
All right, my special thanks there to Catherine Ross from TheStreet and, of course, the great Dan Ives. Let's now get you caught up on a few of the top business stories that we are following for you at TheStreet on this Tuesday morning. We kick things off with news from the folks at Meta. As tech layoffs continue, the company is reportedly eyeing another round of layoffs. According to a Bloomberg story, the tech giant is looking to slash thousands of workers as soon as this week in a bid to maximize efficiency. Back in February, you may remember, Mark Zuckerberg said the company would be focused on, quote, cutting projects that may no longer be crucial to the company. The second round comes just a few months after Meta slashed 11,000 positions, or 13% of its workforce, in November. While Meta has pulled back on spending in a number of different divisions, the company continues to beef up what some call its controversial metaverse efforts. In other news, more price cuts for Tesla, the EV automaker announcing plans to slash the prices of two of its most expensive vehicles in the U.S., the Model X and the Model S, both in a bid to shore up demand. The company is cutting the price of its Model S sedan to $89,000. That marks a 5% cut. And the Model X to $99,000. That's a 9% drop. These cuts mark the second time Tesla has lowered the prices of those vehicles alone, and the automaker's fifth price adjustment this year. Tesla's facing a ton of headwinds, including a looming economic slowdown, rising costs, and of course, increased competition in the industry, those companies both at home as well as abroad. And finally, maybe a bit of turbulence ahead for JetBlue's planned acquisition of Spirit Airlines. This is such a strange story. JetBlue saying that it expects the DOJ to file a lawsuit as soon as today to block the proposed $3.8 billion merger agreement. The deal, which was announced last July, would create the fifth largest airline in the U.S. While the DOJ has not confirmed nor denied, officials have previously expressed concerns that the merger would harm competition among airlines. Of course, if you ask the airlines, they say, no, this is good for competition. We're going to give more options, even though we're taking options off the table. We're going to consolidate. It's going to work out. We've heard this story for a very long time as it comes to regulators and what companies want to do. It's a good story, though. We'll continue to follow it, as we will all the stories of the day, because that's going to do it for TheStreet today, my friends. Thank you once again to our special guest of the morning, Loreen Gilbert, Chief Executive Officer and founder at WealthWise Financial Services, for taking the time to be on the show today. Stick with TheStreet.com for more on these and all of the major market stories that matter to you, and we will see you tomorrow.